American Economy 2000 to 2025. Technology, Crisis and Transformation. A comprehensive overview. The Dawn of the New Millennium, Economic Context 2000 to 2005. The American economy entered the year 2000 riding high on unprecedented prosperity from the longest economic expansion in U.S. history, which had begun in March 1991. The expansion lasted exactly 10 years, the longest in the NBER's chronology. This period was characterized by robust growth, low inflation, and declining unemployment, creating an atmosphere of economic optimism that would soon be tested by major technological and geopolitical shocks. The foundation of this prosperity was built on the revolutionary changes brought by the World Wide Web and personal computing. The mid-1990s saw a worldwide, unprecedented growth in the information technology and telecommunications sectors. The cost of sending and storing information declined sharply. The massive adoption of personal computers and the spread of the World Wide Web revolutionized industry, trade, finance, and services. This technological transformation created entirely new industries and business models that seemed to promise unlimited growth and prosperity. However, beneath the surface of this economic boom lay dangerous speculative forces that would soon bring the expansion to an abrupt end. The late 1990s had witnessed an extraordinary surge in technology-related investments, with venture capitalists and individual investors pouring unprecedented amounts of money into internet-based companies. The dot-com bubble is a stock market bubble that was caused by speculation in dot-com or internet-based businesses from 1995 to 2000. This speculation would prove to be unsustainable, setting the stage for one of the most dramatic market crashes in American history. The Internet Revolution and Technological Progress, 2000 to 2005. The early 2000s marked a critical period in Internet development, despite the dramatic market crash that characterized the era. The 1993 release of Mosaic and subsequent web browsers during the following years gave computer users access to the World Wide Web, popularizing use of the Internet. Internet use increased as a result of the reduction of the digital divide and advances in connectivity, uses of the Internet, and computer education. The fundamental infrastructure for the modern Internet was being laid during this period, creating the foundation for future digital innovations. One of the most significant developments was the massive investment in telecommunications infrastructure that occurred during the bubble years. Before the bubble burst, telecom companies raised $1.6 trillion on Wall Street and floated $600 billion in bonds to crisscross the country in digital infrastructure. These 80.2 million miles of fiber optic cable represented fully 76% of the total base digital wiring installed in the United States up to that point in history and would allow for the maturation of the Internet. This infrastructure investment, though initially excessive, would prove crucial for future Internet development. The Internet landscape was still dominated by a relatively small number of major players, with traditional companies beginning to establish their online presence. Traditional retailers also began using the web as a supplementary sales channel. During this period, the concept of e-commerce was still in its infancy, with most businesses viewing their websites as marketing tools rather than primary sales channels. The technology for secure online transactions was still being developed and refined. Broadband internet access was beginning to expand beyond early adopters, though it remained expensive and limited in availability. The dial-up internet connection was still the norm for most American households, with speeds that seemed glacial by today's standards. The infrastructure investments made during the bubble years would soon enable much faster and more reliable internet connections, fundamentally changing how Americans accessed and used online services. The period also saw the early development of what would later become social media platforms. The Globe was a social networking site founded in 1994 by Stephan Paternotte and Todd Kriselman, which went public on November 13, 1998. It posted the largest first-day gain of any IPO up to that date, with shares closing up 606% from their starting price. While most of these early social platforms would not survive the coming crash, they laid important groundwork for the social media revolution that would emerge later in the decade. The dot-com bubble represented one of the most dramatic examples of speculative excess in American financial history. Thanks mainly to speculation and substantial funding for these new internet startups, investments in dot-coms boosted the NASDAQ Composite Index from 751 in January 1995 to a peak of 5,048.62 on March 10, 2000. This extraordinary rise in stock prices was driven by investor enthusiasm for the potential of internet-based businesses, often without regard for traditional metrics of business success. The financial metrics of companies during this period defied all conventional business logic. According to the University of Florida, the average price-to-sales ratio of companies that went public in 2000 was a scarcely believable 48.9. Indeed, most dot-com companies were operating at net losses, spending heavily on advertising and brand awareness and offering their products and services for free or at sizable discounts. This growth over profits mentality created an unsustainable business environment. The culture of excess extended beyond financial metrics to the corporate culture of these companies. This mentality resulted in tech companies spending excessively on employee vacations, cutting-edge business facilities, and dot-com parties to celebrate new products and services. These extravagant expenditures became symbols of the irrational exuberance that characterized the era. The Federal Reserve's monetary policy also contributed to the speculative environment. The Fed played a significant role by lowering interest rates and capital gains tax rates, making it easier for investors to speculate in technology stocks. The venture capital industry became deeply invested in the internet boom, with unprecedented amounts of money flowing into startup companies. By 1999, 39% of all venture capital investments were going to internet companies. That year, most of the 457 initial public offerings were related to internet companies, followed by 91 in the first quarter of 2000 alone. This concentration of investment in a single sector created dangerous systemic risks that would soon be revealed. The bubble's collapse began with ominous signs in early 2000. On Friday, March 10, 2000, the NASDAQ Composite Index hit its peak of 5,048.62, a high that would not be reached again until April 2015. The following Monday opened with the news that Japan had entered into a recession. The broad global sell-off hit the NASDAQ particularly hard, and it suffered its fourth biggest point loss in history on that day, marking the beginning of one of the most devastating market crashes in American history. The collapse of the dot-com bubble led to a wave of bankruptcies that devastated the technology sector and wiped out billions of dollars in investor wealth. On November 9, 2000, Pets.com, a much-hyped company that had backing from Amazon.com, went out of business only 9 months after completing its IPO. By that time, most internet stocks had declined in value by 75% from their highs, wiping out $1.755 trillion in value. Pets.com became one of the most prominent symbols of the bubble's excesses and subsequent collapse. The scale of business failures was unprecedented in the technology sector. It's estimated that 7,000 to 10,000 new online enterprises were launched in the late 1990s, and by mid-2003, around 4,800 of those had either been sold or gone under. This represented a failure rate of nearly 50%, demonstrating the unsustainable nature of many business models that had emerged during the bubble years. Some of the most spectacular failures involved companies that had raised enormous amounts of capital. Boo.com, an online clothing retailer, had spent $188 million in just 6 months. It filed for bankruptcy in May 2000. These rapid failures highlighted how quickly investor sentiment could change and how vulnerable companies without viable business models were to market pressures. The telecommunications sector was particularly hard hit by the crash. This estimated $2 trillion bubble ended in a similar bloodbath with the bankruptcies of companies like WorldCom and Global Crossing. These failures were especially significant because telecommunications companies had invested heavily in physical infrastructure that could not easily be liquidated or repurposed. Traditional technology companies were not immune to the carnage. Microsoft. Their stock went from 60 cents in 1990 to over $60 in late 1999. Then dropped about 60% during the dot-com crash, and by its low point in early 2009, the stock was down over 74% from its peak. Microsoft products are widely used globally, but their stock did not recover from the dot-com crash until 2016, Even well-established technology companies with solid business models suffered severe stock price declines that took years or even decades to recover from. Some companies that survived the initial crash continued to struggle for years afterward. Blucora, then Infospace, founded by Naveen Jain, at its peak its market cap was $31 billion and was the largest internet business in the American Northwest. In March 2000, its stock reached a price $1,305 per share, but by 2002, the price had declined to $2 a share. These dramatic declines in value represented one of the largest transfers of wealth in American history, as trillions of dollars in paper wealth simply evaporated. However, some companies managed to survive and even thrive despite the crash. Other internet-based companies struggled but survived and are giants today, notably Microsoft, Amazon, eBay, Qualcomm, and Cisco. These survivors would go on to become some of the most valuable companies in the world, demonstrating that while the bubble was excessive, the underlying technology trends were fundamentally sound. The bursting of the dot-com bubble precipitated a broader economic recession that officially began in March 2001. According to the National Bureau of Economic Research, NBER, which is the private, non-profit, nonpartisan organization charged with determining economic recessions, the U.S. economy was in recession from March 2001 to November 2001, a period of 8 months at the beginning of President George W. Bush's term of office. While relatively short, this recession had significant impacts on employment and business investment. The job losses during this period were substantial and concentrated in certain sectors. The Labor Department estimates that a net 1.735 million jobs were shed in 2001, with an additional net 508,000 lost during 2002. 2003 saw a small gain of a mere 105,000 jobs. The technology sector was particularly hard hit, with many companies forced to implement massive layoffs as their business models proved unsustainable and funding dried up. Unemployment rose steadily throughout the recession and continued to climb even after the official recession ended. Unemployment rose from 4.2% in February 2001 to 5.5% in November 2001, but did not peak until June 2003 at 6.3%, after which it declined to 5% by mid-2005. This pattern of unemployment continuing to rise after the recession officially ended would become a recurring feature of subsequent economic downturns. The recession was exacerbated by the September 11, 2001 terrorist attacks, which dealt another severe blow to an already weakened economy. The September 11th attacks accelerated the stock market drop. Investor confidence was further eroded by several accounting scandals and the resulting bankruptcies, including the Enron scandal in October 2001, the WorldCom scandal in June 2002, and the Adelphia Communications Corporation scandal in July 2002. These events created a crisis of confidence that extended far beyond the technology sector. Investment spending, which had been a key driver of economic growth during the 1990s, collapsed during this period. The chart shows that real private domestic investment, which is made up of purchases of plant and equipment, new house construction, and net inventory investment, reached a peak in 2000 and has been declining since then. This decline in investment would have lasting effects on productivity growth and economic expansion in subsequent years. The economic performance of the early 2000s, as measured by gross domestic product growth, reflected the challenges facing the American economy during this period. U.S. GDP growth by 2001 languished at 1% due to 2000's burst of the tech bubble. This represented a dramatic slowdown from the robust growth rates of the late 1990s and marked the beginning of a more challenging economic environment. The recession's impact on GDP was significant but relatively shallow compared to historical standards. The resulting recession was relatively short, at just 8 months, and also shallow as GDP dipped only 0.6% and unemployment reached 5.5%. While the recession was mild by historical standards, its effects on certain sectors and regions of the economy were severe and long-lasting. The recovery from the recession was initially slow and uneven. War spending provided some stimulus to economic growth, helping to support GDP during the recovery period. War spending boosts GDP by 2.8% in 2003, 3.9% in 2004, and 3.5% in 2005. The wars in Afghanistan and Iraq, while creating enormous human and financial costs, did provide some economic stimulus through increased government spending on defense contractors and military equipment. The Federal Reserve responded to the recession with aggressive monetary policy, cutting interest rates to historic lows. The September 11th attacks and the associated economic disruptions may have hastened the recession's end by encouraging the Fed to keep cutting the Fed funds rate. The benchmark rate reached a low of 1% by mid-2003. These low interest rates helped to stimulate economic recovery but would also contribute to the next major economic bubble in housing. Consumer spending, which had remained relatively strong during the recession, began to show signs of strain as the economic recovery progressed. Personal savings has been showing a declining trend, but at about the beginning, 2000 personal saving went to virtually zero, as shown below. This decline in personal savings rates would become a persistent feature of the American economy and would contribute to future economic vulnerabilities. Despite the dramatic collapse of many internet companies, the period from 2000 to 2005 left a lasting positive legacy in terms of internet infrastructure development. The massive overinvestment in telecommunications infrastructure during the bubble years created unexpected benefits for the next generation of internet companies. And because of a resulting glut of fiber in the years after the dot-com bubble burst, there was a severe overcapacity in bandwidth for internet usage that allowed the next wave of companies to deliver sophisticated new internet services on the cheap. The cost benefits of this overinvestment were dramatic and long-lasting. By 2004, the cost of bandwidth had fallen by more than 90%, despite internet usage doubling every few years. As late as 2005, as much as 85% of broadband capacity in the United States was still going unused. This created an ideal environment for the next generation of internet companies, which could access high-quality infrastructure at a fraction of what it would have cost to build from scratch. The survivors of the dot-com crash were well positioned to take advantage of this improved infrastructure. However, some, notably online retailers like eBay and Amazon, survived and later became highly profitable. These companies had developed sustainable business models and were able to leverage the improved infrastructure to expand their operations and reach new customers. The period also saw the development of more sophisticated approaches to online business. The sites that persevered had two things in common: a sound business plan and a niche in the marketplace that was, if not unique, particularly well-defined and well-served. This represented a maturation of the internet business model, moving away from the speculative excess of the bubble years toward more traditional business fundamentals. The dot-com crash, while devastating for many investors and employees, ultimately created the conditions for more sustainable and innovative internet development. The excess capital and infrastructure of the bubble years, combined with the painful lessons learned from the crash, would provide the foundation for the next wave of internet innovation. Companies like Google, Facebook, and Twitter would emerge in the post-crash environment, building on the infrastructure and lessons of the earlier period. Fast forwarding to 2020, the American economy had experienced several major cycles of growth and contraction, including the Great Recession of 2007 to 2009 and the subsequent recovery. When the COVID-19 pandemic struck in early 2020, the United States was in the midst of what had become the longest economic expansion in American history. When President Trump took office in January 2017, he inherited an economy in its 91st month of economic expansion following the end of the Great Recession in June 2009. That expansion continued into 2020, becoming the longest on record, but a sharp contraction in economic activity arising from COVID-19 ended it. The pre-pandemic economy was characterized by historically low unemployment rates and steady, if modest, economic growth. Labor markets were tight, with unemployment having fallen to levels not seen since the 1960s. However, this expansion had been built on a foundation that included significant household and government debt, making the economy potentially vulnerable to external shocks. The pandemic would test the resilience of this economic structure in unprecedented ways. The COVID-19 pandemic created an economic shock unlike anything experienced since the Great Depression. The combination of a global health crisis and the necessary public health measures to control the virus led to an unprecedented disruption of economic activity. Real gross domestic product, GDP, early in the pandemic fell abruptly to 9% below its level at the start of the recession, a much steeper decline than the nearly 4% drop in the deepest part of the Great Recession. This dramatic contraction in economic activity occurred over a matter of weeks rather than months or years. The government response to the pandemic was swift and massive in scale, but the recovery and relief legislation enacted in March and April 2020, plus the relaxation in May of some restrictions on economic activity, led to a sharp, though partial bounce back in GDP in the third quarter of 2020. This represented one of the largest fiscal interventions in American history, with multiple rounds of direct payments to individuals, expanded unemployment benefits, and massive lending programs for businesses. The recovery from the pandemic recession was notably faster than from previous recessions, though it came with significant complications. In the fall of 2020, forecasters foresaw a prolonged shortfall in demand and expected unemployment to stay above 6% through 2021. However, the actual recovery proved to be much stronger than anticipated, leading to unexpected economic challenges. The pandemic fundamentally altered consumer behavior and economic patterns. Business closures and social distancing measures led to a dramatic shift in spending patterns, with consumers moving away from services like dining and travel toward goods purchases. This shift, combined with supply chain disruptions, would create inflationary pressures that had not been seen in decades. One of the most significant economic consequences of the pandemic was the emergence of inflation at levels not seen since the early 1980s. Following the start of the COVID-19 pandemic in 2020, a worldwide surge in inflation began in mid-2021 and lasted until mid-2022. Many countries saw their highest inflation rates in decades. This inflationary surge caught many economists and policymakers by surprise, as inflation had remained subdued for nearly 2 decades prior to the pandemic. The causes of pandemic-era inflation were complex and multifaceted. They find that many forecasters, including those at the Federal Reserve, anticipated that inflationary pressures arising from the large fiscal packages in the U.S. would appear primarily in the labor market, as increased demand for workers put upward pressure on wages and ultimately prices. In fact, most of the rise in inflation in 2021 and 2022 was driven by developments that directly raised prices rather than wages, including sharp increases in global commodity prices and sectoral price spikes driven by a combination of pandemic-induced kinks in supply chains and a huge shift in demand during the pandemic to goods from services. Supply chain disruptions played a crucial role in driving inflation during this period. On the supply side, supply chain disruptions had an important inflationary impact, particularly in 2021 and 2022. The auto industry is a case in point. U.S. auto production dropped from 11.7 million vehicles in July 2020, roughly the pre-pandemic rate, to less than 9 million in the fall of 2021, reflecting shortages of computer chips and other inputs. These disruptions created bottlenecks that prevented supply from keeping up with recovering demand. Energy prices also contributed significantly to inflationary pressures. Rising prices of food and energy added importantly to inflation. Notably, the crude oil market was disrupted by the Russian invasion of Ukraine in early 2022. The price of West Texas Intermediate crude oil rose from less than $70 per barrel in the late summer of 2021 to more than $100 per barrel for most of the period between March and July of 2022, pushing up gasoline prices and the costs of many industrial inputs. This created additional inflationary pressure that extended far beyond energy markets. The scale of price increases was substantial and affected virtually every category of consumer spending. It now requires $119.27 to buy the same goods and services a family could afford with $100 before the pandemic. Since early 2020, prices have risen about as much as they had in the full 10 years preceding the health emergency. This represented a significant erosion in purchasing power for American consumers. Housing emerged as one of the most significant drivers of inflation during the pandemic era, with price increases that far exceeded historical norms. House prices have risen rapidly during the pandemic, creating $9 trillion in owner-occupied housing wealth between the first quarter of 2020 and the first quarter of 2022. This unprecedented increase in housing wealth had far-reaching implications for both the economy and individual households. The housing market's impact on inflation extended beyond direct housing costs to affect broader economic patterns. There are two main channels through which increases in housing wealth can contribute to non-housing inflation. First, the increase in housing wealth can stimulate additional consumption among existing homeowners, either because they feel wealthier or by relaxing borrowing constraints. This wealth effect contributed to increased consumer spending across a wide range of categories. The persistence of housing inflation became a major concern for policymakers. Through June, core CPI inflation was 3.3%. Shelter alone accounted for 2.3 percentage points, or more than two-thirds of core inflation. If shelter inflation were at its pre-pandemic levels, core CPI inflation would be 2.4%, nearly a percentage point lower. This demonstrated how central housing costs had become to the overall inflation picture. The housing market showed signs of cooling by 2023, but the effects on measured inflation were expected to persist. Our estimated model suggests that market rents filter through to shelter inflation very slowly, implying that housing's contribution to inflation could remain elevated for the rest of 2024 and into 2025. This lag effect meant that housing would continue to contribute to inflation, even as market conditions began to normalize. Climate change also began to affect housing costs through insurance premiums. Climate change also exacerbated home insurance premiums in the U.S., which rose 33% between 2020 and 2023. This represented a new factor in housing affordability that was likely to persist and potentially worsen over time. The Federal Reserve's response to pandemic-era inflation represented one of the most aggressive monetary tightening cycles in decades. After raising its target range by 0.75 percentage point in June, July, September, and November of 2022, the Fed raised it by 0.5 percentage point in December and 0.25 percentage point at the beginning of February 2023. This rapid series of interest rate increases was designed to cool inflationary pressures by reducing aggregate demand. The Fed's approach represented a significant shift from its earlier assessment that inflation would prove to be transitory. The Fed stressed that it would take the steps necessary to keep higher inflation expectations from becoming entrenched. This determination to prevent inflation expectations from becoming embedded in wage and price setting became a central focus of monetary policy. The path of monetary tightening continued through 2023, with the Fed ultimately raising rates to levels not seen since before the Great Recession. In March, while acknowledging that recent developments in the banking system, that is, the second largest bank failure in U.S. history, and concern more would follow, the Fed raised its target rate by another 0.25 percentage points in March and again in May 2023 to reach a range of 5.0 to 5.25%. The labor market experienced unprecedented disruption during the pandemic, followed by an unusually rapid recovery that created its own set of challenges. The initial job losses were staggering, with unemployment spiking to levels not seen since the Great Depression. However, the recovery in employment was faster than in previous recessions, leading to very tight labor market conditions by 2022 and 2023. This tightness in labor markets eventually became a contributor to inflationary pressures. Although the inflation did not originate in labor markets, the authors show that tight labor markets are beginning to play a more significant role in pushing up prices. By 2023, there were signs that the economy was beginning to achieve better balance between growth and price stability. New challenges to maintaining an ongoing economic expansion arose following the emergence of high inflation in 2021 and rapidly tightening monetary policy in 2022, but the economy ended 2023 with high employment and falling inflation. This suggested that the Federal Reserve's efforts to engineer a soft landing might be succeeding. The housing market outlook remained a key factor in the inflation outlook. U.S. income growth and, more broadly, the robust U.S. labor market will likely help wring out pandemic-era excesses that led to rapidly deteriorating affordability. Looking ahead, economists and policymakers remain cautiously optimistic about the economic outlook. From the vantage point of October 2022, the subdued expectations for business investment extended to the economy more broadly. Instead, real GDP grew 3.2% over the 4 quarters of 2023. The economy's resilience exceeded most expectations, though challenges remained. The period from 2020 to 2025 has witnessed an unprecedented acceleration in artificial intelligence development, fundamentally transforming how we interact with technology and conduct business. OpenAI debuts ChatGPT, an AI chatbot built on top of the GPT 3.5 large language model, advancing the capabilities of conversational AI and increasing the realist of AI-human interactions. The launch of ChatGPT in late 2022 marked a watershed moment that brought AI capabilities to mainstream consciousness and triggered a wave of innovation across industries. The development of large language models has been perhaps the most significant breakthrough in AI during this period. These models demonstrate capabilities that many experts did not expect to see for years or even decades. When OpenAI revealed o1 in September, it introduced a new paradigm in how large language models work. 2 months later, the firm pushed that paradigm forward in almost every way with o3, a model that just might reshape this technology for good. Most models, including OpenAI's flagship GPT-4, spit out the first response they come up with. Sometimes it's correct, sometimes it's not. But the firm's new models are trained to work through their answers step by step, breaking down tricky problems into a series of simpler ones. This represents a move toward more human-like reasoning processes and has significantly improved the reliability and usefulness